Hi, and thank you for listening to our presentation on the impact of FinTech and distributed ledger technology on the financial services industry. Today's presentation will cover what is FinTech, the advantages of FinTech over traditional banks, technology such as blockchain and peer-to-peer payment applications, the impact of FinTech on traditional banking, and the future of FinTech and traditional banks moving forward. So to start, what is FinTech? Financial technology companies are characterized as agile startups focusing on improving customer engagement and operations via new technologies within the financial services industry. Following the 2008 financial crisis, which weakened consumer trust in the traditional banking system, FinTechs have grown rapidly to over 4,000 companies providing services including consumer finance, mortgages, lending to small and medium-sized businesses, retail payments, and wealth management. As the FinTech industry continues to expand, traditional banks may have to innovate their business strategy to retain their customer base and profitability. As consumer needs develop with new technology, experts estimate that 10 to 40% of bank revenues could be at risk by 2025 due to FinTechs. FinTech companies have several advantages over traditional banks that have contributed to their growing success. To start, FinTech companies are less burdened with physical site operating costs and often employ significant automation, reducing company headcount. These overhead savings allow FinTech companies to offer similar products as traditional banks at a lower cost to the consumer, fueling competition between the traditional banking system and innovative tech firms. Additionally, FinTech companies often lend to borrowers with lower credit profiles and have user-friendly applications through advanced technology platforms, making them more attractive and available to potential customers.
Distributed ledger technology, also known as shared ledger, is a consensus of replicated, shared, and synchronized digital data geographically spread across multiple sites, countries, or institutions. There is no central administrator or centralized data storage. It records and verifies a transaction without exposing any confidential details, relies on cryptography and digital signatures for extra security, also originally designed for digital currencies. Blockchain is the world's leading software platform for digital assets. According to Don and Alex Tapscott, authors of The Blockchain Revolution, the book that was published in 2016, the blockchain is an incorruptible digital ledger of economic transactions that can be programmed to record not just financial transactions but virtually everything of value. Let's take a look at how a blockchain works. Step 1. A wants to send money to B. Step 2. The transaction is represented as a block. Step 3. The block is broadcasted to every party in the network. Step 4. Those in the network approve that the transaction is valid, basically telling or giving a handshake, hey, we approve of the transactions that you have there. Step 5. The block then can be added to the chain, which provides an indelible and transparent records of transactions. Step 6. The money moves from A to B. Let's look at some of the advantages of blockchain. It reduces data redundancy. It is an efficient reconciliation process. It increases the transparency because participants in a transaction have access to the same records. They can validate transactions and verify identities or ownership. It reduces errors. It also has improved transaction speed. Blockchain has been revolutionizing the fintech industry. Let us look at some of the potential uses of blockchain in the traditional banking sector. It streamlines clearing and settlement process. It also decreases the amount of time required for parties to agree on trade terms. It simplifies the reconciliation efforts and also reduces processing delays. Blockchaining reduces cost and operational risk associated with manual procedures. It also improves cross-border payment transactions, create a real-time experience, improve a bank's cash and liquidity forecasting capabilities, decrease exchange rate risk, reduce the risk of overdraft fees. Let's look at some more advantages of blockchain. Anti-money laundering. Anti-money laundering is used in financial and legal industries to describe the legal controls that require financial institutions and other regulated entities to prevent, detect, and report money laundering activities. Know your customer. Compliance is a process of business identifying and verifying the identity of its clients. The term is also used to refer in the bank and anti-money laundering regulations which governs its activities. And some of the advantages it offers is reduce duplicative efforts and operational costs, eliminate headcount, reduce onboarding delays. Blockchain continues to offer more advantages with improved derivative trade process. It reduces the manual trade confirmations and reconciliations. It also decreases operational losses resulting from trade errors or regulatory non-compliances. It also helps with reducing costs associated with the derivative clearing. It also helps to reduce the risk of fraud by providing real-time transaction execution and also providing increased transparency. Some of the limitations of blockchain. There's a lack of technical standards which is continuing to evolve. Also, you must be able to ensure complete privacy of data. And also there is regulatory uncertainty as the technology is continuing to evolve. Let's look at some of the advantages of the peer-to-peer payment applications. They are available all the time, and they are mobile friendly and they are millennial friendly, and more millennials prefer to use the peer-to-peer payment applications that is being evolved now. And also it reduces the cost and it's easier to transfer money from location A to location B in a very fast manner.
FinTechs will continue to grow. The Office of the Comptroller of the Currency has announced that it will make a special purpose national bank charter available to FinTech companies that conduct at least one of the three core banking activities: receiving deposits, paying checks, or lending money. In a speech announcing the decision, the OCC's Comptroller of the Currency, Thomas Curry, highlighted that FinTechs have the potential to expand financial inclusion, reach unbanked and underserved populations, make products and services safer and more efficient, and accelerate their delivery. He further announced the establishment of the OCC's Office of Innovation, emphasizing the need for the traditional banking system to innovate and adapt to the customer needs of tomorrow. Granting charters to FinTech companies helps ensure that these institutions have a reasonable chance of success, appropriate risk management, effective consumer protection, and strong capital and liquidity. If FinTechs continue to solidify their place in the financial services industry, they could draw customers away from traditional banks, potentially leading to a decrease in transaction volume and earnings. The success of non-banks especially impacts smaller community banks who may lack resources to innovate and compete, leading to an increase in defaults and mergers observed. The pressure from FinTech companies has already influenced the type of products offered by traditional institutions. Traditional banks must recognize that customer expectations are being set by FinTech companies, real-time cross-functional capabilities, and therefore develop tools to retain their customer base, specifically millennials. An example of rapid growth associated with FinTechs is the expansion of non-bank lenders in the mortgage market. According to Mortgage Daily, mortgage bankers generated $1.9 trillion in mortgage production in 2016. $846 billion was from banks, $173 billion from credit unions, and $909 billion from non-banks. Among the top mortgage lenders in fourth quarter 2016 were Quicken Loans, ranked third, and PennyMac Financial Services, ranked fourth. The growth in non-bank mortgage lending can be attributed to many factors, including the reluctance of traditional banks to lend to borrowers with lower credit profiles, the ease of use of FinTech's consumer direct applications through advanced technology platforms, and the increased regulatory requirements that banks have experienced since the financial crisis. In 2011, over 40% of the market share was held by Wells Fargo, Bank of America, and JP Morgan Chase. As of 2016, those three banks held around 25% of the market share, losing ground to non-bank lenders such as Quicken Loans, PennyMac, and Freedom Mortgage. In third quarter 2016, banks, credit unions, and other depository institutions accounted for less than half of the mortgage market, marking the first time in 30 years that banks fell below a 50% market share. One potential path forward for traditional banks and fintech companies is collaboration. Many banks have partnered with fintech firms in order to support business processes and offer new products while lowering operating costs. Traditional banks have the benefit of consumer trust and a large customer base, and fintech companies can offer the benefits of cost savings and updated IT systems. In second quarter 2017, KPMG acquired Machi, a fintech company that serves as a matchmaker between traditional banks and fintech startups in hopes of encouraging innovation in the financial services industry. Looking ahead, rising interest rates may lead to a rebalancing among lenders in the mortgage marketplace. While higher rates generate more profit for a lender, they drive down refinancing activity. As a result, borrowers who may not have been given a loan from a traditional bank in the past may now qualify, as there will be greater competition among lenders for borrowers. Additionally, higher interest rates will increase funding costs for non-banks, which can make their products less cost competitive. That concludes our presentation for today, and thank you for listening and learning with us.